I don't think
Yeah,
Chicago's having too good of a
yeah.
weather.
Where are you now, Missy?
I'm actually, for most part, I live in Northwest Arkansas. I just happen to be in Los Angeles right now. Yeah,
Ah, nice.
yeah. And
Looking.
Srini said Austin, 73 degrees. That's nice weather too. Yeah.
Hey, Missy, let me ask you one question, just so I can do a good job keeping an eye on the LinkedIn chat. Uh,
hmm
so I'm at the event, but how do I actually get to the LinkedIn Live section? With LinkedIn?
The link I sent you is to the live session.
Okay.
Yeah, the session is live. Yeah, yeah. You see, it shows here it is live. So yeah, thank you everyone for joining. And today we'll be talking about real estate syndication in total, in general, and just talk about a quick case study as well. I have Charles here, which I'll introduce a little bit later as well. Some of you already know him, Charles Seaman. And for me, real estate is really a instrument where we can invest in that can help us focus on other aspects of our life. And for me, focus on what matters, whatever your life mission is. And before we get into the meat of the presentation, I'd like to remind you that the following content, whatever we're presenting, is for information only. Please don't take it as legal, tax, or accounting advice. Talk to a CPA or your financial advisor. And we'll just have a very simple agenda today with introduction. And I know most of you know me somewhat. And we're going to do absolute basics of syndication, like a very quick run through for those that are a little bit newer, and a case study, and some questions and answers that you can ask as well. So a little about me. I'm the managing partner, also the founder of Life Mission Capital, investing in 158 units in multifamily across both active and passive investments. Managing partner, also the founder of Life Mission Capital. Charles, can you mute yourself? Because I noticed there's a lag with LinkedIn, and you would and also I'm going to. I can't mute people here for some reason. Joy, can you mute yourself too? Yeah. Okay, I can mute. Great, thank you. So I was mentioning about I invested in 158 units in multifamily across both active and passive investments. And right now I'm really working on helping others to do the same, to invest in multifamily. And so they can focus on what matters to them and achieving their financial freedom. And there are so many ways to invest, and I found passive investment is one of the ways that works really well for people that have have the capital but don't quite have the time, but want to balance their portfolio across the stocks investment they have, who are looking for tax shelters because they're high income earners, or just looking for a place where there's a lot more consistent returns in compared to some of the other asset classes. Going back, I'm actually from China. I came to the US as a high school exchange student, and over the years through work and also school, I've gained a diverse set of experience across data analytics, buying, sales, and IT. And that's what I'm putting to use in building my business and building my business for you today. Because of my interest in real estate, I started a real estate investment club within Walmart. And so far, we have more than 400 members. Currently, I still work in Walmart in the supply chain planning analytics side. And I've been previously featured on Agents on Duty podcast and Sotastic podcast, which is, I want to talk a little about Sotastic because if you have kids, you should check out their program. They have podcasts that kind of encourages you and inspires you how to help not just generate the generational wealth, but also help your kids understand how to keep them as well. So my company is really here to enable investors to reach financial goals through exceptional real estate syndication offers. There are three things that sets us apart. One is data. I mentioned earlier, I'm a data person. I got my master's in data analytics, and I've been working in the data analytics field. So for me, numbers has to make sense. I don't like to be too emotional when it comes to investment decisions. So underwriting on the property and the market. And also, I'm a super outgoing person through my sales and just marketing experiences in general. I like to network, and I have a network of experienced and reliable sponsors as well. And the third thing is I'm really here to build meaningful relationships with both my investors and my partners. So I like to talk about our team a little bit. The animation didn't work as I planned, but first of all, with my mentor, also advisor in the company, David Moreau, he's a CCIM, which stands for Certified Commercial Investment Member. He has a wealth of knowledge that is not only apparent in the fact that he's teaching other CCIMs on subjects like market analysis, demand analysis, market cycles. He also has his own investments across 200 units, whether it's personal or through partnerships, and he has also owned his property management company. Specifically working with him, taking my data analytics skills and also his real estate knowledge in the market analysis side, I've been able to do a lot more in-depth underwriting and a lot more conservative underwriting as well. And the next person is Jim Biggs. A lot of you have heard his name as well. He's the founder of the GOB Network. It's a free global wiki for commercial real estate investing, where I actually joined forces with him in helping other people close their deals and help more people invest in real estate. He is not only a sponsor, but also a loan guarantor with more than 2 decades of experience, more than 400 units as a general partner, and more than 800 units as a limited partner. In fact, those numbers should have increased by at least 300 because the numbers are from almost 8 months ago. And I know he closed a few deals since then. And I also like to introduce Charles, just to introduce him briefly. He's actually on the call. I'll have a more in-depth introduction a little bit later. Charles, I've been talking with him. He's one of the partners I follow closely with, and he is a great person and also a great acquisition manager and asset manager. And he hosts one of the free underwriting workshops on Saturday, which we'll talk a little bit more as well. So as you probably saw, that our investment thesis really encompasses of sponsor team with experienced full cycle sponsors, and we're focusing on this market. Mostly southern markets, close to where I live now, which is Arkansas, and places with strong economic growth. We're focusing mostly B or C class, and then the A's and above, with the opportunity for value add and also consistent cash flow, because we don't want to always wait for appreciations to realize our gains. We like cash flows, and that's good for retirement planning, good for financial freedom planning as well. And typically, we're looking for assets with returns in the high teens, meaning between 15 to 20% on an annual basis, between cash flow and appreciation in the back end. Lastly, I just want to emphasize it's so important to invest conservatively during the peak of the market cycle, as many of you have experienced. We're on the peak of the market cycle. We may continue to go on like this for the next few years, but we don't know when that will stop and start dropping. So it's just so important in our investment thesis to look at long-term loans, flexible exits, so we can leave when we want to, when the market is good, and conservative cap rate during exit, and also low break-even occupancies. I have a story to quickly tell. Last week, I was talking to another investor who invested passively in some syndications, and there were two very interesting type of syndicators that he worked with. One type, because the investment was made in 2019, both of those investment, one of them in 2020, March, April, that time frame, they sold their multifamily syndication assets right away because they freaked out about the pandemic. They didn't know what's coming. So investors were able to get their capital back, but they weren't really making any returns. On the other side, the other sponsor, they actually found ways to conserve their cash flow and stayed through 2020, and 2021 came. the market just went upside down the other way, meaning it actually became really good, and then they're able to sell a little bit later in the year in 2021. So it's just so important that we stick with sponsors with experience, invest with experience instead of emotions. So some quick absolute basics of syndications. What is real estate syndications? It is a group of investors, whether it's active partners like me, Charles, Jim, or David. We're general partners. We partner with passive investors. We pull out resources, whether it's expertise from our time, or passive investors' financial resources. We pull it together to invest in an LLC that owns a property. And this is governed by Security and Exchange Commission because it's actually a type of securities. In fact, in 2020, over 120,000 investors participated in syndications, and typically the size is $3 million in its offerings. Some of the things you'll hear a little bit more often is 506B versus 506C offerings. I don't want to get into too much of the details, but essentially, if you're a accredited investor, you can access both of those offerings. If you're not a accredited investor, you can only access 506B. And for 506B, you have to have a pre-existing relationship with the sponsor, with a general partner. So if you're interested in learning about syndications, it's important for you to establish and get to know people who are like me, and get access to opportunities they have that way. And top syndication terminology: simplified, net operating income, which is operating income minus operating expenses before you pay mortgages. And then cap rate, different from single family. In commercial real estate, cap rate is what we use to compare a lot of times if this is a good buy. We're taking net operating income divided by purchase price. That's what we use as a measurement whether this is a good offer or not, but compared to comps, which is what you would use in single family. And the third concept is annual cash on cash return. How much of the $100,000 invested, how much am I getting back on an annual basis after we take out the expenses, after we pay the mortgages, and etc. And then equity multiplier, it's also a return metric. So equity multiplier of 2 means 100,000 investments returns $200,000, and out of that 100K is the investment itself, and the other 100 is the return. And IRR, which is internal rate of return, it's basically calculating the investment return considering the time value of money. $1 today is worth more than $1 tomorrow. And because of that, getting your money back, getting your returns back sooner is going to have higher IRR. Okay, we're getting to the meat of the presentation here. I'd like to introduce Charles. And Charles, I've known him for the past year, and he is a general partner in 398 units with another 385 under contract. I think when we talked a little bit earlier, he has more coming on down his pipeline as well. We're partnering with him in many different ways, but he also serves as a senior acquisition manager in Three Oaks. He has over a decade of experience in commercial real estate in another company, mostly dealing with acquisition, asset management. And even before that, he always managed his own business, whether it's plumbing, bar, or restaurant. Even though Charles lives in North Carolina now, he actually relocated there to do multifamily acquisition. As you may know, North Carolina market is so hot right now, but he's actually from Brooklyn. So without further ado, Charles, I'd like to pass it to you, and I might comment along the presentation as needed, but I'll pass it to you to go through the rest of the presentation. And guys, if you have any questions, feel free to ping in the chat, and we'll have questions and answer time towards the end, and that's when you can ask. Thank you.
Thanks a lot for the introduction and for the great, the great start here. So as she alluded to, we're going to run through an actual case study of a deal. So for anybody brand new to syndication, we can go through an actual example of what a deal is going to look like. So this here is a 48-unit property. It's the second syndication deal that I got involved in. And with this one here, we closed the deal in September 2020. So we're just shy of the 18-month mark right now. So you'll notice from the headline, getting property ready for sale with 75% return in less than 2 years. So one of the benefits to syndication, similar to what Missy said when she was discussing IRR, is the time value of money. So you're going to get a much better return if you wind up having a shorter horizon and delivering great results. Next slide, please. So in this slide, we're going to talk about some of the statistics, how they compare at the time of acquisition in September 2020 to where they are right now. So this particular property we acquired September 21st, 2020. And right now, as we're in the first quarter of 2022, we don't actually have it on the market yet, but it is something kind of in the planning stage that we do want to get prep for sale. So we acquired this asset for $2,475,000. We had a great cost basis, which, right now buying anything at $51,000 a door in the Carolinas is pretty good. And based on current cap rates in the market and where the income at the property is currently, we believe the property would have a valuation somewhere around $4.6 million. So initially the investor capital outlay was $1,348,000. And that's still in the deal because we haven't had a capital or liquidation event just yet. Now, one thing I think that's really important, and this is where it pays to have the right team and the right, the right structure in place for the deal, is when we acquired the deal, net operating income was around $177,000, and today it's about $276,000. So in just 17 months, we've increased the NOI by $99,000. And here's my favorite part: we did that without upgrading a single unit. Okay, so keep in mind, when people tell you the term value add, that's a term that gets thrown out there a lot nowadays. I would argue that value add sometimes can be riskier because you're oftentimes putting money out, not knowing if you're really going to be able to push the rents. In this case, the value add was strictly operational. We put very little money into the property. Now, granted, it was a well-conditioned property to begin with, so there wasn't too much money needed for it, but it was really mismanaged, and that was where we had an opportunity to go in there and do better. Matter of fact, I wish we had more deals like this. So the cap rate, as you can see in the slide at the time of purchase, so this deal was a little bit unique. We got it under contract in February 2020, so it took us about 7 months to close. And the reason for that, you might remember in March 2020, there was a little event that changed things, and that was the pandemic. So the deal had some trials and tribulations. We went through 3 different lenders, and then we finally got the deal closed. And initially, the property was performing poorly, and was performing poorly because the owner was very hands-off. It was mismanaged, and out of 48 units when we first started looking at the property, 12 of those units were vacant. And initially, the purchase price we had was $2,550,000, but we wound up getting a $75,000 credit simply because of the pandemic. So the pandemic actually helped us. So thank you, pandemic. So in this case, when we first started looking at the deal, because the income was so poor and the slightly higher purchase price, we had a mid 2% cap rate at the acquisition. And by the time we closed the deal, it was actually north of 7 because the performance of the property improved substantially. It went from 12 vacant units when we first started looking at it to no vacant units by the time we closed. So the property was full, it was running well, but there was still a lot of meat on the bone because there was opportunity to go in there and push rents. Nonetheless, we were happy to see it full because the seller executed part of our business plan for us, so that got us off to a running start. So the similar properties in the market at that point were probably at a 6 cap. So by the time we closed, we were actually north of 7 just because everything was full, and that made a big difference. So right now, you'll see on the right side, 6% market cap. So that's actually what we were kind of using for the valuation on that $4.6 million number. But the reality is, 6 caps in the Carolinas at this point are few and far between. So, I wouldn't be surprised at all if you can get closer to a 5 or a 5.5 cap, but we always like to be conservative with it. So, the 6 cap is kind of where we would put it there right now. And one very important point that she has in the slide there, this is in less than 2 years. So this number would actually exceed whatever number we had in our presentation for a 5-year hold, and we can do this in 2 years. That's why the returns get so much better. Okay, so you'll notice on the left side, so we gave a wide range when we put this deal out there of 2 to 10 years. One thing I always want to do is make sure that we have enough time to execute, and I don't want to have a gun put to my head in terms of, okay, we need to get this done at this time. So that's why we give big windows. In this particular case, it was probably bigger than most, with 2 to 10 years. And we did that because at the time we were going through the deal, there was a lot of uncertainty with the pandemic. We didn't really know what was going to happen with the economy. And we wanted to make sure we covered ourselves for any possible outcome.
Yeah.
Yep.
And that's a great point you mentioned, Charles. The 2 to 10 years, and for investors, if this is their first time, wanting to invest in syndications, it's just so important. Even though sometimes it was a projected hold 5 years, just in case they have to wait a little bit longer to make sure they get you the great returns. You need to be okay with saying goodbye to the money for longer than 5 years. So just make sure you're okay with that.
Right.
And
yeah, keep in mind, syndications are not designed to be easily liquid. So just keep that in mind. And one other thing to touch on, so you'll notice on the left side, at the time of acquisition, our projected total return, and that was over a 5-year hold, was 71%. And now we're not even 2 years in, we're shooting for 75%. So overall, I think so far, we seem to be doing a better job, as long as the market doesn't collapse in the next few months. And projected annual return, that isn't even close. We were north of 14% at the time of acquisition when we projected it, and we're north of 37% now. Next slide, Missy. Okay, so these are actually some slides from the investment summary that we presented to our investors at the time we were raising money for this deal. And part of the strategy here is, one, we identified that the rents were more than $100 below market rent. And again, we always like to be conservative. So when we first started looking at this deal, even as the property filled up, as we were getting closer to closing, the rents were between $550 and $700. Only one of the rents was at $700. Most were between $550 and $650. And we knew from looking at different comps in the area that we felt very good about $750. And when I say $750, I mean with the units in their current condition, doing no upgrades, just standard turns. So our property manager thought she was even more ambitious than I was. She thought $850 or $900. I thought she was crazy. I'm glad she proved me wrong, because we're hitting these numbers. So the 100 we blew out of the water. We're probably doing 2 and 250 in most cases. So we've exceeded that projection. We opted against charging an additional fee for garage rentals because it's just, even though it's something we probably could have done because they do have spacious garages, we decided just to up the amount of the rent and include it in there. And, it was just something we figured from an optic standpoint, it looks better so you don't have additional fees. So you'll notice one of the things that we put in there was immediately upon acquisition, increase market rents and burn off floors to lease, which will allow us to increase our NOI by over $85,000. So here we are, 17 months later, the NOI is about $99,000 higher. So I think we're pretty close on that. And so far, in terms of the annualized rate of return, we haven't sold the property yet, but if we were to sell it today, I think we'd far exceed 14 or 18%. Next slide. Okay, so on this here, this details the renovation plan. So now, with every property, there's always going to be deferred maintenance. There's things that need touching up. The older a property is, or the less it's been maintained, the more it's going to need. Thankfully, this property was better conditioned, especially in comparison to a lot of the stuff we look at. And part of the reason of that is simply the vintage. They were built in 2 phases, 1995 and 1999. So it was a newer asset in terms of some of the other stuff we look at. But we knew right away 3 of the buildings and the garage buildings were going to need new roofs, so we had that done. The driveway repair was really very minor. I mean, there were a couple of sections that needed patching, so we did that. Garage doors, we actually completed last year. There's about 11 of them. We put new doors in that just were beyond replacement. So we figured out, beyond repair, I'm sorry. So we replaced those and put those in as needed. Gutters and downspouts, we added those as needed. Helical piers, there was one building that had some slight settling, so we put a helical pier in to offset that. And really, we haven't done any interior upgrades. I mean, like some of the units we put flooring, more than that, I think would be a stretch. But my goal with any deal is when you go in there with the CapEx budget is to spend as little of it as possible. I want to raise as much as I can and spend as little. So always spend as little as you can. If you realize that you're able to push rents and to hit your numbers without spending it, don't spend it. Okay, so these are some of the other slides we had in the investment summary. So initially, we had projected a little more equity than you saw on the previous slide, 1,352,000. We raised 1,348,000, so pretty close. Purchase price, that was the adjusted price after we got a $75,000 credit due to the pandemic. Now our actual numbers wound up being about 1.9 million for the loan amount, and the preferred return and everything else held pretty steady. So one thing you'll probably notice is with a lot of companies when they put out investment summaries, they're oftentimes fairly early in the process. So there are still things that are going to change after. That's life. So on the right side, as you see the loan details, there were definitely things there that did change. Our loan amount was 1.9 million. Interest rate, we actually did a little better. We did 3.67, and we did a 12-year term on the loan. So there were some slight changes to it, but overall a similar structure to what we had presented on now. Next slide.
Yeah, and I also just want to highlight quickly about the debt coverage ratio that you see here. It is really high, even after the interest-only period, and that just shows how conservative the underwriting was. And because how conservative the underwriting was, and the market actually took off, and the deal became even way, way, way more lucrative than what we initially thought would be.
Yeah.
Mm-hmm.
I wish we had 10 more deals like this.
Yes. Sometimes the small deals can be really lucrative. It doesn't always have to be 300 units at a time, but yes. Mm-hmm.
Okay, so what we're looking at here is that we bought the property less than a year and a half ago for just under 2.5 million. At that time, the average rent was 606, and the cap rate, I think was actually that number there might be a little off because by the time we closed, it was a little bit north of 7. And getting it ready for sale right now, average effective rent we're getting is 811. And one other good thing about this property that's not really represented in these slides is that collections are fantastic. We're pretty much 100% collected by the end of every month. We have some tenants that pay late habitually, but they always pay. It seems that there are some that just pay by the 10th, some that pay by the 15th, some that pay by the 20th. And each week, as we look at the delinquency report, it goes down and down until by the end of the month, it's pretty much zero. So that's always a great thing. And with current market conditions, we would show you the property worth a $4.6 million valuation. Next slide. Okay, so what does this look like for the investor? So the return to the investor in this case would be 75%. Now this is a pre-tax return, keep that in mind. So as you're looking here, you're getting a 7% preferred return. This is on a $100,000 investment for year 1 and year 2, which is $7,000. So with us, we do distributions quarterly. So in this case, you would get that $7,000 divided up over 4 quarterly payments. And the profit on sale will be estimated to be $60,614. So at closing, when the property is sold, you would get back the initial $100,000 capital outlay, plus your profit of $60,614, coupled with the cash flow is just north of $74,000. So in this case, 2 years, you got your $100,000 principal back, plus an additional $74,000. So your equity multiplier would be 1.74, and that's in 2 years.
And what Charles mentioned about the preferred returns, essentially the percentage of return that would be given to you 100% before any general partners do any profit split. If you recall in the earlier slide, there is a 70-30 profit split after the preferred return and after investor, capital bag, et cetera, et cetera.
So on this one here, this slide's looking at some different tax benefits. So the investor capital was just shy of 1.35 million. Depreciation for year one was approximately 590,000, and the paper loss for a $100,000 investment would be approximately $43,000.
Yeah, leveraging essentially cost segregation and bonus depreciation. That's why commercial real estate is really great for passive investors or investors in general, because we're looking at such a great amount of paper loss for your investment. And cost segregation, it's essentially taking different components of a building, and rather than depreciating them across 27.5 years, like what you would do on a single family home typically, you're taking different components of the home, of the house, of the building, and some of them are going to be depreciated across 3 years, some of them 10 years, some of them 20 years. And then there is also additional incentive to depreciate them even faster based on the bonus depreciation laws. And that's why we're seeing such high depreciation numbers. And that's one of the reasons a lot of people want to invest in commercial real estate syndications.
You know, to an extent, and I'm not an accountant, so obviously speak with your accountant, but tax benefits, I would say, are almost even the number one reason. But why this property runs so well? So, you know, there's a few different things. First one is the vintage. You know, as I touched on previously, the property is built in two separate phases, 1995, 1999. But overall, you know, a decent asset. You know, it's not a 2021 build, but it's also not a 1965 build. So what does that mean? Well, we'll talk a little bit more about that in the next slide. Good part of town. Location is very important, and also the good team. So those things all made for a good fit here that are leading to a good return. Okay, so the first thing is, what's great about the property management team? So, you know, it's very important to have the right management company, because that can literally make or break your deal. You know, your deal is going to be successful, or it's going to fail in most cases at the property management level. You know, you may get lucky, and just because market conditions and a rising tide sinking all ships will give you some help, it may not solve everything. But good management generally will. It'll solve most things anyway. So this one here, you know, the challenge with a property this size is you're going to not be able to afford on-site staff. Properties are always exponentially harder to manage when you do not have on-site staff, but there's a couple of things you can do to mitigate that. So one is to go out there and find the property management company that has experience managing similar sized properties. That's very important. You know, you don't want the company that's managing 200 unit properties to manage a 48 unit property with no staff, because they're gonna look at it like a deer in the headlights, and they'll have no idea what to do. So you need the right company that's used to managing that type of property and that has a team in the area. So a couple of benefits here. The company we hired, they were used to managing these properties, and I would almost say they specialize in properties with no staff. While they do some properties with on-site staff and some for us now, you know, this is really where they kind of got their start. So they really are very familiar with these types of properties and running properties without staff. So another benefit, this particular company has 3 other properties in the Sumter market they were managing. Now, I don't know if anybody here knows where Sumter, South Carolina is. Prior to this investment, I didn't. And what I would tell you is that, you know, finding a company that managed 3 other properties in Sumter already gave me a lot of confidence that, okay, these guys already have some structure there. They already know the market. They know the lay of the land. That's very important. You need to have a management company that has vendor relationships. You need to know somebody that knows the local laws. So these guys already had this structure. They had, you know, they had a system in place. And one of the benefits that we were able to achieve is by bringing this property to them and giving them a 4th one to manage in the market, they were able to hire a full-time manager. So none of the properties were big enough to support full-time staff, but with 4 properties in that market, they were able to split the time of the manager between the 4 properties and make it worthwhile. So that way every property there got a little bit of the benefit of having a manager. without actually having a full-time person. So another thing, great operational execution with minimal follow-up required. This property runs the smoothest of any of the ones that we've had so far. And a large part of the reason is the management team. For me personally, one thing I hate is having to say the same thing twice. If I have to say the same thing twice, there was a mistake somewhere along the way. And it could be on my side. It could be on my side. It could be on their side. It could be somewhere in between. But with this property, it's rare that I had to say anything twice, because usually the first time I told them, they handled it. And that worked really well. If I gave them an instruction, it was rare that I had to go back to them and say, why didn't this get done? Most times they would tell me it was done, and this is what we did. So that goes a long way. Next slide. Okay, so in other older properties, what makes things more difficult? So the first thing is repairs, and that's obviously the big one, repairs and maintenance. There's always things that come up. There's always problems, plumbing issues, electrical issues. Things happen. If you're buying older properties, it's just the lay of the land. As buildings get older, just like people, there's more problems. Things that used to work don't work so well anymore. So you need to get those problems fixed. They start adding up. And, all of a sudden the budget that you went in there with may not be quite accurate because there's just more ongoing issues. And also, aside from that, older properties generally attract less desirable tenant demographics. So newer tenants or better tenants want newer properties. So oftentimes you are getting, lower income and just less desirable demographics as you get into those older properties. Next slide. Okay, so then looks like next thing we have here is, was there one more slide, I believe?
Actually, yeah, I kind of removed it, but another that we can talk about it here as well.
Sure.
Another question that people have asked about why this property performs so well is on which part of town it is.
Right.
And can you talk about how that played the effect
Totally.
on the returns? Mm-hmm.
Yeah. So in this particular case, it's very cliche for people to say in real estate the most important word is location. Well, there's no question on that. Location, location, location. And the reason for that is you can have a good management team. You can have good systems in place. If you buy in the wrong part of town, there's a good chance your ship is sunk. Let's just be clear on that. Because the thing is, ultimately, you're going to struggle to attract good tenants. You could have the best renovated property, but if you're in the middle of the hood, you're going to struggle to attract the tenant demographic that you're going to want. And that's the reality of it. Now, it's not to say that those properties in those areas can't be profitable. They can, but it's definitely a different style of management. If you buy in worse areas or in rougher areas, you're going to struggle to keep management. You're going to struggle to keep personnel. For $30,000, $40,000 a year, most on-site managers don't want to take the chance of getting harmed at work, and I don't blame them. So those are always things to consider. So you have to make sure you're buying in an area that's at the very least stable and hopefully growing. So one thing we really liked about this area is, as a whole, the Sumter market probably isn't on fire, but it's a very stable market. It is the 8th largest city in South Carolina, and the particular section where this property is located is one of the best sections in town. So you can drive down there. There's a lot of retailers, a lot of restaurants, a lot of big names. And, within the 5 to 10 minutes surrounding the property, it's probably the best section of town. If you drive about 7 minutes down the main street there, you're going to hit a new Class A apartment community, approximately 300 units. So that gave us a lot of confidence. When somebody's spending money to go out there and build a 300-unit apartment community, they see something in that area that's worth them spending that money. Seeing nicer retailers, seeing hotel chains, seeing things that are signs of vitality and a vibrant economy, that goes a long way. So those are all things that are important as you're looking at different assets.
Perfect. Thank you, Charles. That's what we had from the actual case study in terms of the kind of key points, just to keep it high level. And I really want to spend the rest of the 20 minutes answer any questions that you guys may have. And before we leave you with some helpful resources to dig further if you're interested in doing that. So I know Charles is monitoring on the LinkedIn side, and I'm here on the Zoom side. So feel free to speak up if you like, or just type in the chat, whatever you prefer.
Let me just throw one quick thing out there.
Oh, sure.
So I'm not quite sure where to find the chat on the LinkedIn site. So I'm a little.
Oh, okay. Don't worry, I got it on my phone.
Okay.
Yeah. Okay, well, I'll give it 5 seconds, and otherwise, I have some questions that's asked by somebody else earlier that I can quickly go through. So some of the questions that I have here is, can I invest with my retirement funds? Yes, you can invest with your retirement funds. Typically, what people do is they use either what's called self-directed IRA or solo 401k, and you can consult with your CPA to see which of those may be better for you. But you can actually invest in real estate, even diversify. You already consider retirement money, which is your traditional IRA. You can convert that to a self-directed IRA or a solo 401k. That's one of the first questions. And then the next question, Charles, that I have someone here asking is, right now with prices are being so high, what are the things that they should watch out for when they're looking at real estate syndications? And what are the risks right now?
So there's always three components to any deal, and that's your sponsorship team, your area, and your property. Of the three of those, I'm going to tell you the property is by far the least important. And that may sound strange, but I'm going to repeat that. The property is by far the least important. Your most important, which Missy touched on earlier, is your team, because your team is going to navigate you through the process. So having an experienced team that has some mileage to them and has had some bumps is probably going to go a long way toward protecting your investment and making sure that it's secure. So the first thing I would look at personally as a passive investor is the strength of the sponsorship team, and just to make sure that they have some track record and they have some experience with success, because that's going to go a long way. Second thing I'm going to tell you is the area. Be confident with the area that you're investing in. And it's great to see a growing area. That's always a plus. I think that's what most syndicators are striving for. But the reality is, as things have become very, very competitive, you'll see some that are probably just stable areas. Now, stable areas aren't bad, because stability can be a good thing, especially when it comes to protecting an investment. But you want to be sure that you're in a solid area that's not experiencing any negative growth, because that can be a red flag. Something else I would say is just projections. Now, for me, it's probably a lot easier because I look at deals on a regular basis. But one thing I always like to be aware of, so if I was a passive investor and I wasn't looking at these deals on a regular basis, a couple of things to look out for. One, to me, is returns that seem too good to be true. And to me, when I see groups starting to get into the mid-20s and whatnot in terms of an average annual return, I really question how conservative are they being? Because anybody can show those numbers, but generally you're probably taking some shortcuts to get there. Of course, with as competitive as deals are right now, if you're being conservative, you're probably not showing mid-20s returns. The highest we've ever shown on a deal was 20%, and that was just on one. Most of us are in the 16 to 18% range, because I tell people straight out, we're going to show lower returns. And my thought for that is I'd rather set the bar lower and be able to potentially jump over it, as opposed to say, okay, I'm going to give you 26%, and then we give you 18, you're disappointed. So, having realistic expectations, I think, is one. And then another one is the annual escalations that you see groups using. So 2021 brought us what are likely the highest rent escalations in history. And it's possible that we'll see some continuation of that in 2022. Probably even that we'll see a good continuation of it. But let me just be clear on this. Double-digit rent growth is not sustainable for the long term. half of America will be on the street if we have double-digit rent growth, year over year over year over year. So look for annual escalations that are realistic. Historically in a lot of markets, you're 2, 3, 4, 5%. Now, even the last 5, 6 years pre-pandemic, things have been higher than that. There is some truth to that. So you can make the argument, maybe higher numbers are merited in certain markets. And I'd say, yeah, there's probably truth to that. But, in the big picture of things, 5 or 6 years probably isn't a big historical perspective. Keep in mind, we've had a lot of market conditions these last few years, namely inflation and printing of currency and things like that have caused rents to rise. So look for realistic escalations, and that'll go a long way. So those are some big things I would say. And then also, in addition to the sponsorship team, just look at who they're using as a management company and see if that management company has experience with other properties or similar type in that same area.
Good point. All good points. We have a question from LinkedIn asking, do you analyze reinvestment risk prior to selling the asset?
Say that one more time, sorry.
Yeah. Do you analyze reinvestment risk prior to selling the asset?
No.
Yeah.
So in certain cases, we may consider a 1031 exchange if the whole group of investors would be interested in that. Now, that does get very tough to pull off with the syndication. So let me just be clear on that. It's not impossible, but it is tough because you have a lot of moving parts and you have to get a lot of different people to agree. But syndications are designed where you're going to have reinvestment, so that's just part of the process. So that's the reality of it.
Yes. And then another question is about what are the risks in this investment? And typically, I can answer it. Just like any investments, you always have the possibility of losing the money you're investing. But what's great about being a passive and limited partner, we also call it, is that your amount of risk is only limited to the amount of money you're putting in. With general partners, we're actually taking a lot more risks, like legal risk, many other risks that that you don't have to get involved in. Being passive, you actually don't have to do much apart from figuring out this is the opportunity you want to invest in and receiving quarterly distributions and tax documents like K1 for your tax filing as well. And the next question is can I sell my ownership in the property before the projected sell time is up?
So the answer on that one is, in most cases, no. Now, you could. So the answer is not definitively no. It's definitively no before 1 year, because it's illegal to sell within the first year after acquiring a non-marketable security, which is what a syndication would be considered. But you could sell after that. Now, let me be clear. It's not the obligation of the syndicator to find a buyer for it. So when people invest in these deals, one of the risks that are outlined in the PPM are that you're investing in a non-liquid asset and that you should expect to keep your funds in for the entire duration of the hold period. So the individual is allowed to go out and find their own buyer. So let's say if they've invested $50,000 or $100,000, they can say, okay, I went and I found Joe Smith, and Joe wants to buy out my $100,000 investment. And then what they have to do is present that to the syndicator, and the syndicator has to review it and either approve or deny and work from there. So it can happen, but in general, I would consider them non-liquid investments. And if you expect that you might need the money back before the full hold period, you're probably better off not investing in that deal.
Got it. And then we have someone asking more of an overall experience question about what was the biggest failure you have encountered in your experience in investing in real estate so far, and what did you learn from that experience?
So thankfully, we've been pretty fortunate. We haven't really had any disaster stories in terms of deals. And part of the reason for that is I guess we went after easier deals. But probably the toughest one that we've had so far was perhaps closing our third deal. And normally I like working under stress and high stress. I do pretty well under that, but I may have kind of overdone it on this one because I was at the point where we almost lost about $350,000, and that would have been, not great. But last January, we were due to close this particular deal on January 28, 2021. And, we wound up negotiating an extension, which allowed us to close the deal the week after, but that extension was very costly. Needless to say, it was better than not getting the extension, which initially I thought the seller wasn't going to give it to us. And it seemed like he was going to hold us in default, which would have cost us a lot of money and probably led to a lawsuit. So I'm glad that didn't happen. And ironically, I've become friendly with the seller since then. But, we paid an exorbitant amount of money, gave him part of our ownership in the deal. And, what we learned from that is that, okay, there's certain things we need to do differently going forward. In the past, what we did is we waited until about halfway through our due diligence period to submit our loan application and to start our offering docs. And the reason we did that is because we just didn't want to spend the money on the loan application or the SEC attorney if we weren't 100% sure we were going to go through with the deal. Because once you pay those fees, you don't get them back. And they can be expensive. The attorney can run you, depending on the size of your deal, probably $10,000 on the low side to, $50,000 on the high side if you're doing a really big deal. And, the loan applications can be about $10,000 to $35,000. So that can be, money that adds up if you do that regularly enough and you don't get it back. So one of the things we learned from that is that, if we want to play in this space, this is a big money space. This isn't, a little risk space. So we need to be able to understand that, okay, that's just the cost of doing business and we need to accept that. And now when we get a deal on the contract, as soon as we do it, we release those things right away so we don't have those situations happen again.
Yeah, that's great. So I think we're about time. I just want to share some helpful information for people that is interested in learning more as we come close to the end of this meeting. You can, to learn more about how to invest in apartment syndication, you can visit, not share. You can visit my website on those 2 ebooks. And here's my contact, missy@lifemissioncapital.com. And this is Charles's contact as well. And he hosts a free underwriting workshop if you're interested in digging into the details, like if you're a numbers person. Every Saturday at 3 p.m. You can reach out to him as well. And another thing I just want to quickly highlight is on my website, I have an FAQ section in case you have any remaining questions that's most likely commonly asked. You can also look at them here on lifemissioncapital.com /FAQs. Otherwise, I think that's it. Is there anything you'd like to add, Charles, or anyone, before we end this call today?
No, Missy, you've done a fantastic job.
Yeah, thank you so much. Great job, Charles. And thank you all for staying on the call. And hopefully this was educational and helpful for your understanding on syndications. Thank you all so much.